What's up, traders? So today I'm going to show you how to do the wheel strategy on NVIDIA to bring in a pretty significant amount of monthly income. Now, if you're new to the channel, my name is Rashad. I am a full-time options trader, and I bring in multiple six figures a year from the stock market, and I use the money I make from the stock market in order to pay for my entire lifestyle. Now, first things first, make sure that you hit that like button, also subscribe to the channel, and do remember that I am not a financial advisor and this is not financial advice. All trading comes with risk. I'm just showing you how I've built wealth over time. Now, if you're watching this video, I'm assuming you're already familiar with NVIDIA. But NVIDIA is a chip maker and they make some of the most advanced chips of any company. And their chips go inside of computers, video game systems. But over the last few years, they've put a large focus on building up AI infrastructures. And their chips are by far the most advanced when it comes to AI. And while NVIDIA stock has had a good run over the last several years, I think that it still has much more room to grow, as I think that AI is still within its first inning. We're just now making huge advancements in general chatbots like ChatGPT, but that is just the beginning for AI. Once we get into the full build out of autonomous driving and things like the humanoid robot, you can easily see that we have a long way to go. And that bodes really well for NVIDIA as they have the best AI chips. So let's take a deeper look into NVIDIA's fundamentals. So NVIDIA's ticker symbol NVDA, and it's currently a $106 stock, and it has a market cap of $2.3 trillion, and it has a current PE of 38. Now, for a company that is growing both earnings and net income as fast as NVIDIA is, a 38 PE is not bad at all, especially when its competitors such as AMD is trading for a much higher PE ratio with much less growth potential. Now, NVIDIA has done amazing over the last 5 years with both their revenue and net income. We could see in the year ending in January of 2021, they did $16 billion in revenue. Then 2022, they did $26 billion, 2023, $26 billion, 2024, $60 billion, and then 2025, $130 billion. So that is amazing growth, and that is exactly what you want to see when a company's revenue and net income goes up just like a staircase. And what might be even more impressive is their net income, because NVIDIA has amazing profit margins. So they did $4 billion in 2021, $9 billion in 2022. They did have a setback the year ending January of 2023. However, we can clearly see when more AI orders started to come in, because between the year ending January 2023 and the year ending January 2024, they increased their net income by 581%. And I may be wrong, but I don't believe there's any company that was already a large cap company who improved their net income by 581% in the span of one single year. All right, but they did $29 billion in the year ending January 2024, and then they did $72 billion in the year ending January 2025. So needless to say, their fundamentals are amazing. But let's dig a little deeper. So there are currently 43 different analysts that are covering NVIDIA, and they all collectively have it as a strong buy. And we can see that their price targets, they have a high target of $220, a mean target of $167, and a low target of $115. Well, the thing is, it's currently trading for 106. So it's currently trading for less than what their most bearish analyst has it currently rated. And that just gives you a glimpse of the opportunity that is at hand. But with that information, let me first discuss the wheel strategy. And if you're familiar with the strategy already, make sure you stay to the end because I'll show you a better way to go about it. But if you're new to the wheel strategy, I will discuss everything shortly. And then right after that, we'll take a look at the data points that I like to look at prior to placing any single trade. Now, first things first, what is the wheel strategy? Now, if you're new to options, I'm going to explain everything now. However, if you're already familiar with the option strategies, make sure you stay to the end because I'm going to show you a better and more effective way to go about it. All right, so with the wheel strategy, the first thing you want to do is sell a put. And when you sell a put, you are agreeing to buy a stock at a cheaper price. And for selling a put, you receive money. And then once you buy the shares, you can turn around and sell a covered call. And with a covered call, you are just agreeing to sell a stock at a specific price. And when you sell covered calls, you collect money as well. And then once you sold the shares, you have completed the wheel strategy. But that's why it's called the wheel strategy, because you can just continue to do those steps over and over and over again. But let me break down selling puts and selling covered calls a little bit more. So when you sell a put, there are two main objectives. And it's one, to generate income, or two, to buy the underlying stock at a cheaper price. So when you sell puts, you either one, want to make money, of course, and or two, you want to buy the stock at a cheaper price. And selling puts is literally like selling insurance for stocks. And here's what I mean. Let's say I have ABC stock that is currently trading at $100 and I like the company and I want to purchase the shares. So I could potentially sell a put at, let's say, $90. And as I'm selling a put, I'm essentially saying to the buyer, hey, I will buy your shares of ABC stock that are currently trading at $100 and I will buy them from you if the stock crashes below $90. However, for doing so, you have to pay me, let's say, $200 right here, right now, and this contract is only good for the next 30 days. And from there, two things can happen. Let's say ABC stock stays above $90, then we just keep the $200 we were paid and we go about our day, and we can do that trade over and over and over and over again. However, scenario number two is if ABC stock drops below $90, then we still need to purchase the shares of ABC stock at the $90 that we agreed upon. However, we still keep that $200 that we received. And so as a put seller, you are essentially selling insurance for the stock. And just like with your car insurance that you pay every single month, the insurance company keeps the premium that you pay them whether you get into a car accident or you don't. And so here's a quick example of selling a put with a real stock. So let's say Apple stock is currently trading for about $220. And let's say you're interested in buying Apple stock at a cheaper price. Then what we could do is we could sell a put, let's say at $200, and that would be our strike price. And we could select an expiration that is 30 days out. And for selling this put, we would receive $150 immediately right here, right now. And so if we look at this profit and loss chart over here, so Apple stock is currently $220. If the stock price were to go up, then we just keep the $150 we received. If the stock price stays the same, then we just keep the $150 that we received. If the stock price goes down some, we still keep the $150 we received. However, if the stock price dropped below our $200 strike, then we will be forced to buy 100 shares of the company per contract that we have. And that's literally how selling puts works. However, now let's go and take a look at the few data points that I look at prior to selling puts. And so looking at NVIDIA's chart over the last year, we can see that it peaked right here at about $153 on January 7th. And since then, it's been mainly on a downtrend. However, what I want to point out is that buyers typically step in every single time it drops below $100. So this is the $100 mark right here. And you can see it dropped under that last August, and that was just for a single day, and it popped right back up. And then over here at the beginning of April, it dropped below 100 for about 3 days, and then it popped right back up. And then most recently on April 21st and 22nd, it was under $100, and now it is back over 100. So there is clearly buyers ready to step in to buy NVIDIA every single time it touches 100. So now we'll look at the data points that I like to look at prior to placing any trade. And the first one is the Bollinger Bands. So the Bollinger Bands are these lines up here, but they just aim to show you the price range that a stock is expected to trade within. And so we can see here on the bottom end, it's $96.54. And then on the top end, it's $113.95. And so since with the will strategy, we have to start off with selling a put, I will likely make sure that my strike price is under this $96.54 mark. And the second thing that I want to look at is the expected move. Now, the expected move is just the move up or down that the options market has priced in for a stock by a specific expiration date. All right, so let's take a look. Now, since we want to get monthly income, I'll go somewhere around 30 days out to expiration. And so this expiration 32 days out looks perfect to me. And we can see that it currently has an expected move of $12.11. And so on the lower end, that would put it at $94.22. All right, so the Bollinger Band said $96. The expected move shows $94. And typically I will select whichever one is more conservative of the two. So now we'll just keep the $94 mark in our minds. And if you want to know where I get all this data from, this website is barchart.com. They have a ton of advanced features and data sets. However, if you use my link in the description below, you'll get your first 30 days for free. Absolutely free. So go ahead and give it a trial. You can go ahead and cancel it free of charge if you decide that you don't like it. However, I pretty much use this website every single day. So check it out. The link is below in the description. However, let's head on over to Thinkorswim and check out the last data point that I like to look at. So now we are in the option chain of NVIDIA. And if we look at the expiration that was 32 days out from now that we were previously looking at, if we recall, the expected move set about a price of $94. However, the last data point that I want to look at is the delta. Now, the delta by definition tells you how much an options premium will move per a $1 move in the underlying stock's price. So if we look at this delta of 0.30, which is right at the $100 mark, that is saying for every $1 move in NVIDIA, the options premium will move 30 cents. However, most successful investors that I know look at the delta as the probability of the event occurring. So at a delta of 0.30, that tells me there's about a 30% chance that NVIDIA stock price, which is currently $107, will drop down to $100 by the expiration date. And so in other words, you would have about a 70% probability of profit. However, I personally like to stick to deltas below 0.20. And so if we look over here, we can see the delta of 0.20 is right at the strike of $94. And so that strike sounds good to me. So if I wanted to go ahead and place this trade, I would go ahead and select the bid price, and I would go ahead and load my order ticket. Now from here, you need to decide how many contracts that you're willing to sell. Now, do remember that there are no free lunches in the stock market, and every single contract that you sell is an agreement to buy the shares of the company if the stock price were to drop below your strike price. So do remember, if by expiration date, if NVIDIA stock was below $94, then I would be forced to buy 100 shares of the company at that price. And so you can personally determine, based on your account size and how much shares of NVIDIA you would be willing to buy, how many contracts that you would like to open. And for me personally, I like to kind of dollar cost average in. So maybe I'll do a contract today, and then a contract tomorrow, then a contract the next day, the next day, the next day. However, for the purposes of this video, let's say we accumulated about 10 contracts. So I'll go ahead and put 10 for the contracts. And at a mid price, we'll get about $228 for every single contract. And so if you like the trade, then you could go ahead and hit review and place the trade. However, let's go down and look at the profit and loss chart. All right, so if we pay attention to that number there at the top left, that is how much the trade will be worth. So we can see right here where these red dots are is where NVIDIA stock price is currently at $107. And so we can see if it were to expire right here at $107, we would just keep the $2,280 we were paid, and we would go about our day, and we could do the trade over and over and over again. Now, if the stock price were to go up, we just keep the $2,280 that we were paid. If the stock price goes down some, we just keep the $2,280 we were paid. It's not until NVIDIA stock price starts to go below $94, which was the strike price that we set, that we'll see we'll start to make less and less and less and less. And then our break even point is right around $91.72. All right. And then from there, if it were to go down even more, then you would start to lose money on the trade. However, we would be fine with that because we were fine with buying the shares at the $94 mark that we set. Okay, so this is a bullish strategy. However, it gives you a much larger margin of error, because say if we were to buy the shares today at $107 and it dropped down to 94, well, now you're down over 10% already. However, if we just sell these puts here today at $94 and the stock drops down to $94 and we're assigned the shares, then we're pretty much even as far as the shares go. And on top of that, we always keep the premium that we were paid. All right, so that is why you sell puts, because it has a high probability of profit and you get a large margin of error. And thirdly, of course, you get paid just to wait around. But the great thing about the will strategy is you oftentimes make more money on the call side once you are assigned the shares than you do on the put side. So let's take a look at that. But real quick, if you know anybody who would like to generate income off the cash that they already have, then please tell them about the Trade to Freedom community. The link is in the description below. But not only will they get my exact trades when I enter them, but they'll get my full options course from A to Z, which shows you my entire framework for trading options. Thirdly, they'll get access to ask me questions at any given time. And then lastly, they'll be within a community of other traders who all have the exact same goal as them. So if you know anybody who needs to generate more income off the cash that they have, tell them about the Trade to Freedom community. The link is in the description below. And so the objective with covered calls is to generate income and profit from a stock that you already own. And that is the reason it's called a covered call, is because you already own the shares of the company. So when you go to sell a call, it is covered by the shares that you own. And here's a quick example using Apple again. So let's say we own 100 shares of Apple at the $165 mark. That's the price that we paid for the shares. So that is our cost basis. Well, now we could turn around and sell a covered call, let's say for this example, at $185. And we'll still do it for 30 days out, and we received $200 for doing so. Well, if we look over here at the profit and loss chart, this is how this works. If Apple stock goes down, you keep that $200 that you received. If Apple stock stays at around $165, you keep that $200 you received. If Apple stock goes up some, all the way up to $185, you just keep that $200 you received. However, if Apple goes above $185, then you still keep the $200 that you received. However, now you are forced to sell your shares at that $185 mark that you agreed upon. But here's the great thing about covered calls, is not only do you get to keep that $200 option premium that you received, but you also get the capital appreciation of the stock. So we bought the shares of Apple at $165. And if it goes above 185, then you still get to collect that $20 price appreciation on top of the premium that you received. However, now you cap your capital appreciation at whatever strike that you selected because you agreed to sell the shares at that price. And so let's go ahead and take a look at a covered call. All right, so now we're back at the options chain, and now it's time to sell covered calls. Now let's assume we had already sold puts and the stock came down, and let's assume that we were assigned shares at $110 for NVIDIA, and now it's trading at $107. Well, now what we can come over and do is we can sell covered calls at anywhere up to our cost basis. So if we were assigned the shares at 110, we could technically just turn around and sell covered calls at 110 as well. And that's typically what I like to do. I like to go pretty close to my cost basis. And it's like, yes, will I miss out on some capital appreciation if NVIDIA were to skyrocket? Yeah, I sure will. But I like to go with the guaranteed money because I can always turn around and continue to sell puts on NVIDIA to get it back at a lower price. All right, so let's say that's exactly what we want to do. We want to go ahead and sell our calls at $110 because we now own the shares. Well, same thing. I would just come over here and select the bid price, and it will automatically populate my ticket for me. And we did 10 contracts before, so let's just type in 10 again. And it looks like I will get $6 per share or $600 per contract. So let's go ahead and look at the profit loss chart again. Now at the red dot where NVIDIA is currently at $107, we can see we would just make the $6,000 that we received from selling the contracts. And if the stock price goes down, then we just keep that $6,000. And if the stock price were to go up some, then we still keep that $6,000. However, once it hits $110, then that is where your capital appreciation ends, and you will be forced to sell the shares of the company if the contract expires higher than $110. And now this can be a little bit confusing because you can see as I go higher and higher on the stock price, it starts to look like a losing trade. However, because you have the shares of the company, this won't impact you because you've agreed to sell those shares at $110. And this is more so as if you did not have the shares. But as long as you have the shares, it is considered a covered call. And we would just keep that $600 and we would just be forced to sell the shares at $110. However, we keep that $600 per contract in premium that we received. And that is how I will run the will strategy on NVIDIA stock. But ladies and gents, that's it for this video. Again, if you know anybody who needs to generate income off the cash that they already have, then tell them about the Trader Freedom community. The link is in the description below. They'll be able to see my exact trades. They'll get my entire options trading framework via the course. They'll get full access to me, and they'll be within a community of other traders who all have the exact same goals as them. So go ahead and join us. But I hope you learned amazing info from this video. I wish you the best in your trading journey, and I hope that God blesses you with more than you can even handle. But that's it for this video. I will see you guys on the next one. Peace.